You'd think by now the ground beneath us would feel steady, but in energy, we know better. Fundamentals shift, strategies realign, and the playbook constantly evolves. That's where we find ourselves today, standing at another crossroad. I'm tired of using that word. Where market forces, geopolitics, and technology collide. I'm Mark Roach, and this is FutureWise Energy, my platform for addressing these challenges head on. Drawing on decades of experience in the oil field boardrooms and deal tables across the globe, I cut through the noise and try to deliver grounded, actionable perspectives that matter to energy professionals like you. And here's the truth that we need to face. The numbers tell a stark story. West Texas Intermediate is priced at $68.15 a barrel today and Brent at $69.94. At a time when U.S. production is hitting historic highs, an impressive 13.5 million barrels per day. Our rig count has plummeted, though, to just 539, the lowest in nearly 4 years. This marks 10 straight weeks of declines. Producing more while drilling less, it's not sustainable, and the global stage is equally unsettling. OPEC Plus, once the caretaker of price stability, has pivoted sharply. Their August production hike of 548,000 barrels a day wasn't just bigger than expected, it signaled intent. They're prioritizing market share over price control, and with Iran breaking production records not seen in decades, sanctions or no sanctions, it's evident that global supply is recalibrating in ways that can't be ignored. Meanwhile, global demand is soaring, a record-breaking 103.7 million barrels a day, even as inventories swell by 1 million barrels a day. That kind of imbalance doesn't just correct itself without consequence. Closer to home, the impact of these shifts is already being felt. Projects viable at $75 a barrel are on uncertain ground at $68. Marginal wells in the Permian, once no-brainers, are now under scrutiny. The industry shift towards free cash flow and shareholder returns is quietly curbing future supply, potentially. And then there's the workforce. 3,153 energy service jobs gone in June alone, bringing employment in the U.S. in the sector to 635,077. This isn't a minor dip, it's a reflection of deeper structural recalibration. On top of all that, we face the complexities of China's energy strategy. The country consumes nearly half of the global energy demand while driving 58% of renewable energy growth, yet still burns more than half the world's coal. This calculated contradiction allows China to position itself as a climate leader while maintaining industrial dominance. Chinese affiliated organizations have funneled over $500 million into 4,000 climate-related projects in the U.S., extending their influence in clean energy narratives here. Over 5 years, China has avoided importing 87 exajoules of energy through its renewable energy efforts, exceeding all of Europe's energy consumption. It's a strategic move that's reshaping the sector. Meanwhile, U.S. producers wrestle with capital constraints that limit innovation and capacity investment. The focus is less on immediate performance and more on positioning for long-term stability. Adding another layer, the cost of climate adaptation continued to mount. In the past 12 years, U.S. climate disasters have cost $6.6 trillion, doubled the adjusted losses during the Great Depression. Events like refinery-damaging floods in Texas aren't isolated. They underscore rising volatility. Environmental realities now have a direct line into business risk. Advances in technology offer a degree of margin relief. Rig safety sensors and private 5G networks help extract efficiencies even as operational activities decreases. But technology can stretch the fundamentals only so far. It doesn't circumvent supply, demand, or the need for capital discipline. The main issue isn't whether the current environment will pass, but the degree to which companies prepare for what comes next. Asian markets are driving sustained demand growth. System pressure is rising, and the natural declines in the field are unavoidable. The only certainty is ongoing volatility with rebounds on timelines that remain unpredictable. Companies aligning operational tactics to stay flexible and competitive will be best situated for whatever lies ahead. Declining prices, OPEC Plus's strategic recalibration, Iran's output, and China's broad reach aren't temporary anomalies. These are markers of structural change. Navigating this environment calls for investment in efficiency, well-considered technology adoption, and maintaining strategic discipline over expansion for its own sake. Energy is in a period of realignment. The fundamentals are shifting, and energy's rules don't guarantee relevance tomorrow. Periods of transition require measured, informed decisions, those that protect downside risk and preserve optionality for future moves as the sector continues to evolve. This perspective is built from decades spent where fieldwork meets boardroom negotiation. Adaptation is not an option. Efficiency and discipline and foresight provide the footing required in a landscape defined by uncertainty. I'm Mark Roach, and this is FutureWise Energy, wishing you all the best.